All right, let's dive right into this explainer. Today, we're completely reframing how the C-suite needs to look at ESG in 2025. You know, for a long time, environmental, social, and governance criteria were kind of sidelined, right? Treated as just a secondary compliance issue or maybe a marketing exercise. But wow, the landscape has radically shifted. Today, we are looking at this strictly through the lens of enterprise value, risk management, and true competitive advantage.
We're going to follow a risk-to-reward trajectory today. Our agenda covers the new value driver, decoding materiality, navigating frameworks, the private equity playbook, and finally, executing advantage. Let's jump in.
Section 1. The new value driver, ESG, in 2025. Let's start with the immediate reality here. ESG is no longer just some tedious compliance exercise. It's a fundamental value driver for your business. To really grasp the scale of this shift, think about this. Institutional investors managing over $100 trillion globally are now signatory to the Principles for Responsible Investment. $100 trillion. They are systematically integrating ESG criteria right into their capital allocation and decision-making processes. So, what does this mean for your C-suite? Well, it means your company's sustainability credentials are now directly, inextricably linked to your cost of capital and your overall market valuation.
The core premise today is that we aren't just talking about the environment in isolation anymore. We're talking about enterprise risk, enterprise value, and the very foundation of your corporate operations. Basically, ESG is now completely embedded into the architecture of how modern, resilient businesses actually operate and how they're evaluated by the broader market.
It's honestly staggering to think about, because the pressure isn't just coming from investors looking for an upside. We are facing a massive regulatory and litigation tidal wave in 2025. Take the European Union's new Corporate Sustainability Reporting Directive, or CSRD. An estimated 50,000 companies are falling under these strict new mandatory reporting laws. Globally, multinational companies are navigating over 2,600 different climate laws. And stakeholders, well, they are getting incredibly aggressive. For example, the $244 billion Dutch pension fund, PGGM, recently demanded strict human rights accountability directly from the supply chains of major brands. Add in the rapidly escalating reputational and litigation risks for greenwashing, and man, the risks of getting this wrong are simply monumental.
Moving on to Section 2, decoding materiality, financial versus impact.
Before we really get into the weeds of materiality, let's clear up a major point of executive confusion. You'll hear the terms frameworks and standards thrown around interchangeably all the time, but they are very different. Think of frameworks as the overall approach. They tell you the what. What topics should you actually care about, like climate risks or social impact. Standards, on the other hand, are the detailed rules. They dictate the how, the specific, repeatable metrics you absolutely must use to report on these topics. To communicate effectively with the market, you need both.
Now, if you take only one technical concept away from this explainer, let it be the concept of double materiality. It's quickly becoming the global standard, especially under those new EU CSRD rules we just mentioned. It essentially forces you to look through two distinct lenses. First, financial materiality, which asks how sustainability risks affect your company's actual bottom line. And second, impact materiality, which flips it and asks how your company's activities affect people and the environment. You really have to capture both perspectives.
And look, this isn't just theory. By applying this double lens, companies are finding incredible, actionable operational insights. For instance, during a recent consulting engagement, a major European retailer applied a double materiality assessment, and they uncovered these massive hidden environmental risks deep within their textile supply chain. We're talking risks that traditional financial assessments completely missed. Finding that out drove operational changes that ultimately reduced their environmental impact by 15% over just 2 years. It's a hugely powerful strategic business tool for trend spotting and enterprise risk management.
Section 3. Navigating frameworks. Choosing the right fit.
Choosing a framework shouldn't just be based on whatever is popular at the moment. Knowing how these map out cuts through all the clutter, allowing you to instantly align your organization's specific strategic needs with the correct framework. If you need comprehensive multi-stakeholder engagement, the GRI is a global pioneer used by over 80% of the world's largest corporations. If your primary audience is investors, while SASB focuses strictly on industry-specific financial materiality, TCFD is your go-to for assessing climate financial risk. And of course, if you operate in Europe, CSRD is mandatory, strictly enforcing that double materiality standard we just talked about.
Section 4. The private equity playbook, ESG in deal-making.
The data on this is just staggering.
73% of private equity investors already have strong ESG frameworks in place to drive their deal-making. They have moved way past viewing ESG as some optional add-on. For them, it is now a core component of how they shield their investments from regulatory risk and ensure a much higher valuation upon exit.
And let's look at just how deep they're going. During M&A due diligence, private equity firms aren't just looking at the financials anymore. They are executing incredibly deep operational audits. They're comparing actual production numbers against what is legally permitted by pollution boards. They're checking if a manufacturing plant is extracting unpermitted groundwater in water-scarce zones. Why? Because they know that poor waste disposal or non-compliance can instantly kill a transaction or just completely destroy long-term profitability. They're basically using ESG to uncover hidden liabilities long before they ever sign a check.
Section 5. Executing advantage. Driving enterprise value. Companies proactively tackling this are unlocking massive value. Research actually indicates that ESG-strong firms can achieve up to 33% higher operating profits than their peers. It's driving incredible business innovation too. Take BioBean, for example, a British startup that created a massive competitive advantage just by turning coffee waste into biofuel to power London's double-decker buses. How cool is that? Furthermore, strong ESG ratings unlock specialized capital. Just a simple ratings upgrade can help a company secure hundreds of millions in green bonds. And crucially, artificial intelligence is now stepping in to automate the heavy lifting of all this multi-framework reporting. It's turning what used to be a labor-intensive cost center into a totally streamlined, predictive analytics engine. To get there, your C-suite needs to confidently adopt this 4-step execution strategy. Step 1. Adopt a multi-framework strategy to satisfy both investors and your broader stakeholders. Step 2. Prioritize mandatory regulatory compliance, like the SEC rules or CSRD, above voluntary measures. Always do what's required first. Step 3. Map your stakeholders to ensure you're reporting what actually matters to them. And Step 4. Invest heavily in technology. Using AI and integrated platforms is really the only viable way to manage this data accurately and at scale across your entire enterprise.
The landscape of corporate disclosure is solidifying incredibly fast. It's becoming more structured, highly enforceable, and globally harmonized. So the question is no longer whether your organization will need robust ESG reporting. The frameworks exist, the AI technology is readily available, and the capital markets are absolutely demanding it. Leaving you with one vital question to answer at your next board meeting. Will your organization leverage this to lead the ESG transformation and build a true competitive advantage, or will you be left struggling to catch up? Think on that, and thanks so much for joining this explainer.